Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shandong Chenming Paper Holdings Limited annual report. Shandong Chenming Paper Holdings Limited offers a diverse range of businesses and services across various sectors. The company's primary operations include pulp production and paper making, with a wide variety of products such as culture paper, coated paper, white cardboard, copy paper, industrial paper, special paper, life paper, newspaper, thermal and glassine paper, and household paper. In addition to its core business, the company also engages in various other activities. These include generating and selling electric and thermal power, forestry, saplings growing, processing and sale of timber and construction materials, manufacturing and selling wood products, purchasing and selling waste, providing wall materials, panels, and coal, as well as financial leasing and equipment financial and operating leasing services. The company's services also extend to various industries such as catering, hotel management, marketing, capital market, funding, arboriculture, logistics, transportation, printing and packaging, machinery manufacturing, trading, property investment and management, commerce, business factoring, investment management, wholesale and retail, investment, finance, port, cargo transportation, and business services. Furthermore, the company is involved in electricity, tea, property, and real estate businesses. With a wide range of activities across various sectors, Shandong Chenming Paper Holdings Limited has established itself as a diversified conglomerate with a strong presence in China and internationally. Shandong Chenming Paper Holdings Limited market capitalization of 7 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Shandong Chenming Paper Holdings Limited holds a significant advantage in their industry. Shandong Chenming Paper Holdings Limited trades at a higher price-to-book ratio of 0.87 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 80% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the given summary. On the growth side, several companies have shown significant increases in revenue, including Shaoguang Meilun Paper Co., Limited, Zhangjiang Chenming Pulp and Paper Co., Limited, and Jiangxi Chenming Paper Co., Limited. These companies have reported substantial revenue growth, with some exceeding billions of RMB. In addition to these company-specific drivers, the hotel and property rental segments have also contributed to revenue growth, with increases of 215 million and 154 million RMB, respectively. The others segment has also seen a significant increase in revenue, amounting to over 290 million RMB. On the decline side, the machine-made paper segment has experienced a substantial decrease in revenue, totaling over 1.5 billion RMB. Discontinued operations have also led to a decline in revenue, with a decrease of over 1.5 billion RMB compared to the prior period. Furthermore, asset impairment losses have increased by nearly 906 million RMB. Overall, these drivers highlight the key factors contributing to revenue growth and decline in various segments and companies. But net income experienced a significant decline between 2023 and 2025. The decrease was substantial, with net income dropping by 201% from 2023 to 2025 and by 207% from 2024 to 2025. This drastic drop in net income is also reflected in the RMB 8,296 million decrease in 2025. The decline in profit margins was even more pronounced. Initially implied to be negative due to large losses reported, the situation was partially alleviated by a year-on-year decrease in wood pulp prices. However, this improvement was short-lived as intensified market competition and fluctuating raw material prices led to a further decrease in profit margins. Several factors contributed to these changes. The shutdown of production bases and idle production at Zhangjiang base significantly impacted the company's finances. Additionally, industry downturns, supply-demand imbalances, and price decreases of major paper products all played a role in the decline in net income and profit margins. The company's operating cash flow is a topic of debate in the given summaries. On one hand, several pages indicate that the company is generating positive operating cash flow, with net cash flows from operating activities ranging from RMB 243 million to over RMB 2.6 billion. These positive statements are found on pages 9, 11, 168, 170, 291, and 337. On the other hand, there are also multiple pages that suggest negative or unclear operating cash flow. Pages 32, 33, 34, 240, 242, 276, 284, 288, 310, 331, 343, and 345 all indicate that the company is generating negative operating cash flow. The conflicting statements throughout the report make it difficult to determine a clear conclusion about the company's operating cash flow. However, based on the sheer number of pages indicating positive operating cash flow, it can be argued that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have shown mixed trends over time. While there are instances where the debt level has increased, such as a total liability increase of RMB 20 billion, 742,746,734.87 from RMB 30 billion, 83 million, 2,921.8 to RMB 50 billion, 825 million, 748,655.67. There are also sections that indicate a decrease in debt levels, including a significant drop in cash received from borrowings by 41%, from $14.15 billion to $8.23 billion. Similarly, interest expenses have decreased in some instances, such as a 16.87% reduction from 2024 to 2025, but no clear trend emerges overall. The mixed trends in debt levels and interest expenses suggest that the company's financial situation is complex and has undergone various changes over time. While there are indications of increased debt levels and decreased interest expenses in some sections, other parts of the report reveal a more nuanced picture. To gain a comprehensive understanding of the company's financial health, it would be necessary to review the entire report rather than relying on isolated summaries. The company's ability to manage its debt and interest expenses effectively is crucial for its long-term sustainability. The mixed trends in these areas may indicate that the company is working to balance its financial obligations with operational needs. However, without a clear overall trend, it is difficult to assess the effectiveness of these efforts. The performance of various regions and segments in a given context has been analyzed. Two areas have shown notable success: Shaoguang City, where positive results are mentioned on page 146, and Zhejiang Province, also highlighted as performing well on the same page. These two regions stand out as having achieved satisfactory outcomes, while no information is available to indicate any underperformance from other areas. Management is optimistic about the company's future prospects, having overcome challenges and secured its foundation for business development. The company will focus on efficiency and cost reduction measures to overcome industry challenges and implement a 1-2-5 strategic development plan. To achieve this goal, management plans to advance digitization and standardization in procurement operations, build a top-tier management team, and strengthen the production foundation through 5 key initiatives. This includes integrating resources, optimizing asset structure, concentrating strengths, focusing on core business, and improving quality and efficiency. The company's future capital requirements will focus on technological upgrades and capacity expansion, with a mix of internal funds, government guidance funds, policy support funds, and syndicated loans. Management is committed to strengthening end-to-end cost reduction and efficiency enhancement, adopting a benefit-centric approach to enhance market analysis, continuously optimizing product structure, and driving the company towards sustained, stable, and healthy development. Overall, management's strategy aims to position the company for long-term success by leveraging technology, improving operational efficiency, and making strategic investments in key areas. A review of company dividend and share buyback activities, the extracted summaries reveal that a particular company has engaged in dividend payments as part of its financial activities. This information can be found on page 274 and page 344 of relevant documents. On the other hand, there is no mention or indication of share buybacks or repurchases in any of the reviewed pages. In conclusion, based on the available data, it appears that the company has indeed paid dividends to its shareholders at some point. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have increased by 2.09% from 2024 to 2025, with a notable rise in carrying amounts of raw materials and goods in stock. This buildup may be attributed to fluctuations in international prices of wood pulp and wood chips, as well as reliance on external procurement of raw materials. The supply chain disruption is also a pressing concern, with production bases in Shaoguang, Jiangxi, and Jilin largely inactive during the first 3 quarters. The shutdown of the Shaoguang Meilun production base and the idleness of the Zhangjiang base throughout the year have further exacerbated the issue. However, there are some positive developments that may mitigate these concerns. The resumption of operation and production at 5 major bases since August 2025 is a step in the right direction. Additionally, the company's efforts to upgrade production lines and equipment will likely increase efficiency and reduce costs, potentially alleviating inventory buildup and supply chain disruption issues. Nevertheless, the provision for inventory impairment, made if net realizable value is below cost, highlights the ongoing risks associated with these concerns. That concludes the financial summary for Shandong Chenming Paper Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.